So I have to use this for a few seconds. I guess I'll just make a short introduction. As you notice, this meeting will be in English. So I'd like first to thank all the speakers for coming. Svetlana, Marcelo was coming, join us now, Caio and Fernando here. So just to give you like, I also need to thank actually Bradesco Asset Management for sponsoring. Well, thank you very much for doing this together with us. And I also need to thank actually Caio and Marcelo Fernandez was not here. They organized a international workshop of Financial Econometrics, and this is like a initial session of the workshop that will happen actually over this weekend. So just to give an idea of what we're going to be doing, first we're going to have a presentation by Svetlana, and then this is going to be followed by shorter presentations by Marcelo and Caio. And then we're going to have a round table where you can also ask questions. So I guess during the presentation, we'll just refrain from ask questions, but we can have a discussion afterwards as well. Okay. So Svetlana, thank you very much.
Thank you so much for such a warm welcome and for inviting me here. So I would like to talk a little bit about essentially the past, the current life, and also the future of machine learning in finance. And in particular, one of the ideas that I'm going to try to illustrate with different examples and different contexts is that quite often off-the-shelf algorithms that we have from extremely powerful and really nice machine learning techniques, they're not enough when we're using them in the context of asset pricing. And we need to adapt them. Essentially, we need to put economics into the machine learning. I'm going to show you in several cases how that can be done, at least in terms of making the first steps in that direction. And in the end, I'm also going to be talking a little bit about where I think this literature is going and what we are yet to see. Okay? So I don't think that I need to introduce the factor literature in asset pricing because it is everywhere in academic research and in asset management. This figure gives you the number of citations that the president of the American Finance Association every year kind of delivers a paper, which is known as the presidential address, hence the title. And so then it is also published in the Journal of Finance. And what we see here is that over the last 10 years or so, there is one paper that clearly stands out. So this was the presidential address of John Cochrane, when he coined the term factor zoo in his PhD conference. You also notice that one of the follow-up presidential addresses that also gathered a lot of the citations is Kamhari, P. Hacking, and the factor zoo. So the second place goes to Luigi Zingales, does finance benefit the society, which arguably is an incredibly important question, but at the same time, a very difficult one. And maybe this is why, we don't really see a lot of the follow-up work on that direction, because it's actually really hard to answer a question like that. Yeah. But there is a lot of interest in the factor models, both from the academic and of course from the industry perspective. And the reason is because cross-sectional asset pricing, which first was pioneered by Capem in the model of Sharp and Littner back in the 60s, is the backbone of the current asset allocation. So there are billions and billions of dollars attached to that, and almost all the predictability that is explored practically in the asset management literature is cross-sectional, not the time series. So for those of you who kind of are not familiar with this context, think of it as the following idea. One type of predictability, the time series one, is where based on what happens today, we try to say whether the share price tomorrow is going to be higher or lower compared to where it is today. This is the time series predictability. It is within that particular stock. It is a very difficult problem. The time series predictability in financial markets is very limited. Most of it originates only at extremely long-term horizon, and even then, the R squared that you get is actually quite low. There is some predictability that we know can be explored at very high frequency data, milliseconds level, but that is also a very special case. But the majority of the predictability which can be explored empirically is the cross-sectional one. This originates from the following logic. If today I have two stocks, let's say Apple and Microsoft, and I observe something about these two companies, can I say whether tomorrow the return on Apple is likely to be higher than the return on the Microsoft? That is, this predictability is not about whether something is going to have a positive or negative rate of return tomorrow, but whether it's going to outperform some other security or not. It's a relative predictability, and that is exactly what is explored in both traditional academic, let's say, asset pricing and empirically asset allocation for the majority of firms. So KPM was the first model developed that could rationalize why different stocks have different expected returns, some higher and some lower. And it linked it to the beta, that is the exposure to the market-wide fluctuations of the corresponding securities. The higher was the beta, the higher is going to be the expected return of the stock. And in that world, that was the only source of systematic risk. But empirically, of course, that is not the case. And empirically, we have developed a plethora of different strategies based on various cross-sectional signals that exploit firm fundamentals. And usually they are formed in the way of portfolios that are used by sorting. That is, let's say today we have all the stocks and we sort them based on their assets or based on their cash to, for example, liquidity, or based on book-to-market ratio or anything else. Then we would expect that the stocks which are at the bottom of this whole group are going to have, let's say, a high or lower rate of return compared to the stocks which are in the top level of the group. Yeah? So this is how sorting generally works. And of course, it has a lot of the statistical underpinning behind its logic because it's basically a non-parametric estimator of return. But this is a very non-standard one because we're not looking at the neighbors, to the left and to the right. And when you are close to the border between these two groups, just a little movement is going to be completely allocating you to either, let's say, group number 1 or group number 2. So it has a lot of the non-standard properties, but still it's non-parametric estimator that we kind of understand its features. So over the years, starting from the famous size and value anomalies, people have come up with many different cross-sectional strategies like that. For example, we know that small firms, those that have small market capitalization, they offer a higher rate of return compared to large caps. We know that stocks that have high book-to-market ratio, which are known as value companies, they also have higher return relative to the growth firms, those for which this ratio is very low. And all of that is, of course, inconsistent with KPM and inconsistent with many other models. And so people have started exploiting this type of cross-sectional predictability in designing additional sources of risk, such as size and value factors, which together with market form a French 3 factors. Then we got momentum, then we got many others. And today we live in the world with more than 300, and actually that was as of 2012. And with all the machine learning and big data, right now we're probably closer to 600 factors that people have developed over the years. Most of these factors are based on firm fundamentals. And again, they're formed by sorting. That is grouping similar securities based on their underlying economic properties. Clearly, 600 is too much. And especially since most of the papers are going to be usually talking about, I have found just one more. And this is the one that you should really be paying attention to, because that's the one that offers the best risk-return trade-off and alpha, which is not spanned by traditional sources of risk. So invest in this. But as any asset manager would testify, and I'm sure that the guys from Bradesco are going to also support this, actually gathering all the alpha, which the majority of these papers document on paper, is incredibly difficult. And outperforming traditional benchmark is a task that has been almost impossible, really difficult to beat for the majority of the asset managers in the world, even the most talented ones. So obviously, people started to think, okay, we can't have 600 sources of risk, and every single one of them offers another 100 basis points of pure return. Something has to be wrong here. So we either need to do selection or we need to do aggregation. So how do we do that? So first, let's think a little bit about factor selection. There are many ways in which that can be done. If you use machine learning techniques, then lasso would be a natural solution. Because lasso allows you to select a smaller number of variables from a larger set. And you can modify this procedure in many, many different ways so that it would have various nice properties. So when I say lasso, I do not mean traditional, lasso from 1996 paper by Tip Shirani. What I mean is just the whole class of these penalized estimators that are going to have an L1 property of some kind attached to them. So these are the estimators that are going to be putting to zeros exactly, many different coefficients. When do they work? Well, actually, again, these estimators have been studied extensively in both statistics, econometrics, and machine learning. And we know that they require a set of fairly stringent assumptions. Stringent assumptions that are difficult to test, if not impossible, in a traditional world. Why is that? Well, one of those assumptions is that the true model that you're trying to recover is actually sparse. How do we test whether the model is sparse or dense within the traditional regression framework? We don't really have the majority of tools that would allow us to compare these two alternatives. They also tell you that if you want your model to work well and the lasso to give you the correct answer in selection of the factors, that means that the best performing model should be well separated from the second best. That is, we're really going to be targeting the truth. It is unique, and that's why we try to sort of converge there. We try to select it. How do we know that the true set of risk factors is unique? Maybe there are different ways in which I can repackage the same underlying economic risks. And there are actually quite a lot of arguments in favor of that. Because for those of you, more familiar with this literature, think about how many different measures of investment of a firm and factors based on that have you seen in the last 5 or 10 years. I can probably name at least 12, just on the top of my head. So there is a lot of proxies that try to measure the same underlying economic risks. So selection among them, therefore, is going to be a very daunting task, if not impossible. And so it shouldn't really come to you as a surprise that if you were to look at all the recent literature that tries to do factor selection using all the different methods, quite often pioneering in this area of research, and every single one of those methods says we have model selection consistency, that is, we have a reliable way to select a true sparse small set of factors, you will find one very uncomfortable finding, which is that all of those papers, they select different variables. So if every single one of them says that that selection is the reliable and is the truth, then how come they all give different answers? So I think that the answer to this puzzle is actually in trying to examine the assumptions behind the validity of the lasso and the machine learning techniques that guarantee variable selection, which once again go back to the idea that the sparsity pattern that we are trying to recover with these methods, it has to be correct, which is of course a hypothesis, when we run the procedure. Again, there should be a true model and it has to be unique. It needs to be well separated from the second best, because only then we can separate them and identify them properly. And of course, that model is going to be sparse. The majority of applications that we have in finance quite often deal with objects which are very much related to each other. So for example, we could be talking about multi-factor beaters. We could be talking about standard covariance between factors. We could be talking about price of risk, or we could be talking about risk premium. All of those objects are sort of related to each other, but even a small kind of error in where you assume the sparsity is located is going to have a huge impact on the density or sparsity of related objects. So here's one example I want you guys to have in mind, again, for those of you who are kind of completely out of this literature. So think of it of two matrices. One is going to be, let's say, the variance covariance matrix, and the other one is going to be its inverse. Clearly, they are tightly related to each other. But if you assume that it's the precision matrix that is going to be sparse, that actually has a lot of zeros, it will turn out to be that the variance covariance matrix that is dense. And if you assume that sigma itself is going to be sparse, then obviously sigma minus 1 is going to be really dense. So point is, even small kind of changes in that location, of the sparsity assumption can sometimes have a really large impact on your empirical findings. You can also do factor aggregation, where the obvious idea is to use something like principal components. Yeah, principal components as a natural way to aggregate data have been used for decades in financial and economic research. But for a particular reason, when people tried to apply it to finance back in the 70s, it failed miserably. It didn't deliver any of the factors that have a reasonable Sharpe ratio. It didn't deliver any of the factors that would be able to explain why, on average, we have this high return on, let's say, Apple or Microsoft, or low return on some other securities. Standard principal components also require a set of assumptions that are going to be likely violated in finance. That is, they usually assume that we're looking for factors that target the time series variation, not the cross-section. Think about the following. What do we need to know to extract principal components? We need to know the covariance matrix, right? So we're looking for the sources of risk which explain most of the time series variation and returns. But what is expected returns? Where is that difference of the average return on Apple versus Microsoft? It's been eliminated because covariance matrix is going to be looking at the mean return in the first place. That is the whole object of interest that we're after, expected returns. It doesn't even enter the objective function of the standard principal component analysis, which is why we end up with factors that have great time series variation, systematic variation, but there is nothing that guarantees that those factors are going to come with a high risk premium attached to them, and as a result are going to be investable and are going to be a good idea from the asset allocation perspective. There are many ways in which one could try to modify them. One of them belongs to my co-author, Markus Felger, which is called the risk premium behavior, where we modify the objective function in such a way so as not to just extract factors that capture most of the time series variation and financial returns. But there is also that second part, which tells me that the loadings on those factors should directly map into the expected return on those securities. That is, we're looking not only for factors that drive most of the time series variation of stocks and financial markets, but factors that would act a little bit like in the Kaplan world. So that if I have a stock that has a higher loading on that factor, it should also come with a higher rate of return. So as a result, we're trying to nudge the factor discovery towards those that come with a high Sharpe ratio, with a high risk premium, not just time series volatility. It turns out that empirically, it actually performs much better compared to traditional models. It also obviously has a lot of different limitations, but we're going to come back to them in a second. There are ways in which one could also try to adapt current machine learning techniques, but within the context of, again, latent factors and the decomposition of the asset returns under the arbitrage constraints. So one of the recent papers was by Ban-Ke-Liao Neural, which combines the neural networks to get this very flexible time-varying estimation of the factor loadings and the risk premium, but still relying on the idea of latent factors like principal components at the sources of the systematic risk and return. So now we have a bunch of tools. We've got selection, which can be done maybe by lasso or related things. And we've got factor aggregation. And so you can think of them as being two extremes. Yeah, because on one hand, we're dealing with a set of just observable factors, 3, 4, 5. On the other hand, we're dealing with the complete latent factors. Where we are, can we meet somewhere in the middle? This is exactly the questions that we've been asking in a recent paper with my colleagues, Christian Juliard and Jen Daufman. We wanted to see whether it is actually possible to test the sparsity or density of the cross-section of the asset returns. And as a result, whether we can do both selection and aggregation at the same time and let the data speak in terms of what is going to be more appropriate set of assumptions to use an empirical analysis. So I'm not sure if we're going to have enough time to go through it because actually kind of the math behind that paper is quite technical. So just as a brief preview of what do we find in that analysis. we develop a Bayesian model averaging technique based on the spike and slab priors, which allows you essentially to exactly ask the data whether we should do selection or aggregation. Crucially, all of that setting is adapted precisely for financial context. That is, we're not looking for the factors that explain the time series. We're looking for the factors that are going to be carrying high Sharpe ratios. We're looking for the factors that are going to be able to explain a cross-section of asset returns. And all of the parameters of that model can be mapped to economic fundamentals. So think of it as shrinkage or tuning parameters for the priors. They're all mapped to economic objects like Sharpe ratios, number of factors, investable frontier. And what we find out is that the model space is flat. There are hundreds, if not thousands of models that deliver exactly the same cross-sectional, which I hope is one of the findings that is going to be at least to put to rest, the standard horse races between different factor models. We have forma French factors versus, 7-factor model versus Lujan kind of investment base versus behavioral factors versus models that come with the machine learning. What these analysis shows you is that those questions, which one of those models is the better, best one, actually doesn't really have an answer. So maybe we should stop doing this type of horse races in the first place. And the reason is because many of those factors, again, capture the same underlying economic risks. And if they are indeed capture the same economic underlying risks, this means that you shouldn't be selecting them. You should be aggregating. But how to do that? You can do just an average. You can do a weighted average based on how useful is the particular factor for explaining the cross-section of the asset returns. This is also what is going to be automatically delivered by this method. It's going to be looking for the best combination with the whole purpose of explaining the cross-section of asset returns. And if some factors are really useful and they really provide a standalone source of economic risk, they're going to be selected as a standalone value. If others are going to be noisy measures of the same underlying economic risks, they're going to be aggregated with the weights directly driven by how clean is their signal-to-noise ratio, how useful it is in measuring the expected returns of the stocks. So, how do we do this? So for those of you kind of familiar with a bit of a Bayesian statistics, we're going to be considering the standard linear factor models. There is a cross-section of asset returns. And again, they're going to be driven by exposure to certain systematic sources of risk. So it's the usual model where we're looking at variances, betas, and its price of risk. In the Bayesian world, we learn about parameters. So we usually start from the time series properties of the data. So we draw, standard variance covariance matrices. We sort of try to essentially almost simulate, from the data, which is consistent with the in-sample estimates of the parameters. So we start with the vectors of expected returns and the covariance matrix. As a result, we get the posterior distribution of those parameters. But crucially, all of the asset pricing models, they tell you about the cross-sectional relationship between those parameters, which is why we have the step 2. The step 2 tells me that expected return on all these different securities should be driven by exactly their exposure to that potential source of risk. So I'm interested in the price of risk associated with these factors, which is why the Bayesian estimation of a standalone model, single set of factors, is going to be coming in these 2 steps. First, the time series bit, like a time series regression. And second, the cross-sectional bit that ties up the covariance matrix of the returns to the price of risk that given factors are going to be generating in the whole cross-section of securities. This type of 2-step procedure, hierarchical prior if you want, allows us to estimate all of the underlying parameters of the model. So we get also the estimation uncertainty around it, not just an R-square, but the confidence interval for the R-square. We similarly get properties of Sharpe ratios, alphas, tail risk, anything that goes along with the performance of the given linear factor model. But now that we have a single model, how do we compare different models, or how do we aggregate them? Again, in the Bayesian world, we have a natural answer to this question. That is, we're going to be measuring how good is the corresponding model, factor model, in explaining a cross-section of asset returns. And the higher is going to be the likelihood in the data, the higher is going to be the weight of the corresponding set of factors. But what is the likelihood of the model fitting the data? It's exactly the same cross-sectional relationship that I mentioned. So we're going to be judging the quality of each set of factors based on how well they're going to be fitting the overall model. Once we have those weights, we can aggregate different models together. Some of those models might include just one variable. Others might have several. We do not take a stand on whatever the data is actually going to suggest. So it could be that we're going to end up ultimately with a weighted average of all the possible combinations, and there's going to be just one factor that stands out. Let's say the market, if it was the copper world. Alternatively, if the world is something like principal components, where there's a lot of the aggregation, we're going to see that different models that have different combination of factors, they're doing pretty much the same job, and they should all be sort of like weighted with each other. But once you do that, you can also do all sorts of investment analysis. You can also do investment strategies based on the aggregation of these models. You can measure alpha. You can do risk adjustment, again, based on the aggregation of all these models or selection, whatever comes out of the data, without taking a stand on the choice of the factor. Now, if we have a lot of different factors, let's say 50, 60, or maybe even 500, we have to think about all these different combinations of the models. So the model space is going to be exploding. Traditional spike and slab prior that allows you to essentially choose whether you have a model with a lot of degrees of freedom on the particular role of particular factors, but with a few variables, or you have a lot of the different factors, but then ultimately the impact have to be regularized so as to not have overfitting. So this endogenous choice between the two is completely fine when you have a small number of models. But if you go through each of them one by one, you feasibly can deal with only millions of potential specifications. So computationally, this becomes a really difficult problem if you were to look at the fit of every single possible combination of the factors, even with as simple as linear factor specification. So what do we do instead if we want to say something about the whole set of potential factor models? We have to go into the world of the continuous spike and slab. Think about it this way. Instead of just saying that factor either has to be there or not, 0 or 1, I'm saying that the factor has to be there with a certain probability. And I'm going to be learning about that probability. So if the factor is a very strong signal about the cross-section of asset returns, that probability that is part of the model is going to be close to 1. Could be 90%, could be 80%, could be 70%. If the data says that the factor is absolutely useless in explaining the cross-section, that means that it's going to become part of the model with a probability close to 0. So this is the idea behind the continuous kind of spike and slab analogy. Crucially, we can set up the whole system in such a way so as all the parameters of the model that you're going to be estimating empirically are going to be mapped into observable economic fundamentals. There is no tuning parameters. There is no cross-validation left here. If you tell me what are your reasonable expectations about Sharpe ratio achievable on the market, some people would say it's 2, others would say it's 4. Some people would say, well, maybe actually getting anything above 1 is going to be very difficult to do. So all of those either more optimistic or conservative beliefs can be directly embedded into the analysis. If you tell me what are your beliefs about the density of the factor model, you could say, I haven't got a clue, in which case it's going to be flat. Or you could say, I'm actually pretty certain that there is a small number of factors driving everything that can be embedded into the estimation as well. So what do we find out from the data? We consider the space of about 60 factors, which generates a little bit more than 2 quadrillions of potential models. This seems like a huge number because it's, 10 to the power of 15, something like that. In terms of stars, for example, this would be equivalent to 25,000 galaxies. Or in terms of brains, it could be 15 brains. But, this audience is much more familiar with the machine learning, so I'm sure you have a lot more synapses. Point is, the complexity of this problem looks large. But actually, all of the analysis from the whole universe of these factor models can be implemented using our techniques within just 1 hour on my office computer. So computationally, it is incredibly powerful and very flexible too. We find that most of the models, the top leading models, there is almost no separation between them. If you were to do a formal test between top 2,000 specification of the factors, you wouldn't be able to distinguish their cross-section as surprising. Which again tells you that the choice of that single, best performing 3, 5, whatever 6 factors is just a fruitless, search. But at the same time, there are some variables that do stand out. A lot of them related to the post-earnings announcement drift. Some of them related to this, behavioral, quite often biases that we observe in financial markets. The market factor is, of course, has to be there. But the majority of the factors you see here on the graphs, they're going to be much closer to each other, which means that they package the same underlying economic risks. So those factors, they shouldn't be selected from. These factors should be efficiently aggregated. Overall, there seems to be a large number of factors in financial markets, but they're clearly not belonging to that space of long-short portfolios that we have been forming over the years. They have to be united together. So maybe one could use principal components, because one could say your model could be dense in terms of various long-short anomalies, but it's going to be sparse in terms of 5 principal components. Not at all. Principal components are really bad at explaining the cross-section of the asset returns. And even if I implement the risk premium PCA, the correction of my long-term co-author, Marcus, you're still going to see that the majority of those RP factors are not going to be selected as those that should be really a source of risk in the model. So that means that actually we still don't know what is precisely way to aggregate different data in a few interpretable factors. We know that we're somewhere in between aggregation and selection, but we are neither in the sheer aggregation or sheer selection. So the best of both worlds, which can be achieved with a Bayesian model averaging procedure and spike and slap analysis, allows you to test exactly that. These are investment strategies that can be used out of sample, and they really perform quite well. But mostly, let me finish by talking a little bit about where I think the kind of machine learning and all these quantitative methods are moving in research. Which is that if you think kind of from the broader perspective, machine learning techniques are absolutely great at solving 2 different classes of problems, right? So they do a lot for prediction, they do a lot for classification. Prediction is fantastic, but in finance and economics, we usually make decisions which take multiple inputs into account. So for example, in terms of the portfolio construction, we're interested in the best trade-off between risk and return. So if I take just the stocks which have been predicted by my best machine learning to have the highest rate of return, that does not necessarily make the best investment, because those methods do not take volatility into account. You can also be on the opposite side of the bench. You can have methods that directly focus on the volatility and really try to minimize and make that volatility more robust. Again, think of principal components, but they do not say anything about expected returns. Unfortunately, this type of split between what is the objective function of the method is a general feature of all the off-the-shelf procedures that have been suggested and developed so far. And we think that this is one of the ideas why the use of the machine learning techniques in asset allocation so far has been quite limited. It actually seems to be much more promising on the risk management perspective rather than sort of designing the portfolios. And the reason is because, again, off-the-shelf methods, they always take into account only one aspect of the problem. But what we need to do is we need to put economically motivated objective functions. So that if I were to use neural networks or Bayesian methods for asset allocation, or random forest. I'm going to be targeting directly the object that I want is going to be of interest for either researcher or the portfolio manager. Sharp ratio. In one of the other papers that I have, again, with Marcos and my long-term co-author, we actually show that random forest, despite its appeal on the interpretation and sort of the tree-based structure of the potential investment universe, is a really bad idea if you want to form portfolios for precisely this reason. Random forest targets expected return. The volatility of the underlying assets and how they co-move with each other never enters objective function in any way. And we also show how one could modify this procedure so that it is actually suitable for asset allocation. But this is not going to be a random forest anymore. And more so, we are beginning to see more and more applications that fundamentally change the idea behind either the algorithm in which particular machine learning technique is going to be applied, or they change the objective function that the algorithm is going to be targeting. And this is where we can actually do a lot. For example, there are almost no methods that would look at dynamic portfolio rebalance, because almost all of the methods, whether we use statistics, financial econometrics, or standard machine learning techniques, they target a fixed investment horizon, 1 month returns, quarterly returns, maybe annual returns. But the way I form portfolio today is going to be impacting my decisions going forward. So, for example, rebalancing costs. Yeah. So that means that I shouldn't be treating asset allocation as just a sequence of one period investment problems. I should either be imposing some smoothness constraint, or in general, I should be thinking about the term structure, if you want, of the decision making. And this is something which is currently absent from the majority of the methods. If you think about the scope of investment strategies, so the source of risk and return, all of the models we have been using so far have something like a constant return to scale, as in we're just studying returns and we're studying different patterns of those returns. But the simple idea that the more money I put into implementing a particular strategy, the more price impact I have. And as a result, the lower is the capacity of the strategy going forward, decreasing returns to scale in the generation of the alpha. Something which is absolutely bread and butter in any large asset management firm, price impact costs, is completely absent from our models as well. When we're talking about the macrofinance disconnect, that is, the apparent different behavior of the economic fundamentals and financial markets, even though when we think about financial markets, we sort of understand that they are, of course, related to macroeconomy in a variety of different ways. But somehow in the data, it's really difficult to pin down their connection. The thing that we forget is that financial data is extremely high frequency. The macroeconomic data is low frequency. So what we have here is the mixed frequency type of data. And quite often, the macroeconomic fundamentals, it takes time for them to reflect what already happened in financial markets. So you don't have the contemporaneous model, you have this change in the lead and lag type of relationships. So all of those different ingredients so far are absent from the machine learning literature. And obviously, this is going to be one of the steps forward in which we're going to be adapting various objective functions and generating methods that are going to provide reliable and much more realistic view of the world. So machine learning is great. And this was never kind of supposed to be as, let's make machine learning great again. Not at all. It's already fantastic at what it has been designed to do. But in finance and economics, we have different set of problems. And so I think that it's time that we develop tools that are going to be building up on all the best things that we already know and are going to provide new solutions to the problems that we are facing. Okay, thank you very much.
Thank you, Svetlana. Caio, would you like to join us now?
Sure.
Slight change in so you have 100 slides.
Very challenging. Hi. So thank you for the invitation to be here. So after Svetlana's talk, I don't know if I should talk about this paper anymore. There's no like twists in machine learning. Is like a very basic application of like neural networks. This is joint work with the Jianxin Fan, Gustavo and Francesca, my co-authors. So in this paper, what we try to do is to verify like if like we can use machine learning methods to improve option pricing via a hybrid approach. So basically, we thought the idea. So you know, if you think about like option pricing, there are many different ways of looking from the perspective of a modeler. So in the last, let's say 55 years, people have been proposing like a rich set of models, and you know, like there are things like to see like which object to focus, risk neutral density, the cross section of option price, implied volatility surfaces. Like the one was saying, like each of these things is a different way of representing, in this case, like options, and depending on like what is the angle that you're taking, the model is going to be completely different. And we make a choice here, like to look at the implied volatility surface, because that's like a very common object for practitioners. And we thought about the idea of like, can we look at what are the option pricing models that are trying to, you know, like come up with an approximation for this implied volatility surface, and to see if we can boost the models by using a machine learning technique, a very simple one, neural networks. So that's what we do in this paper. So since I have 10 minutes, I'll have to skip like many of my slides. But what we do is like a hybrid two-step approach, where first we use the option prices to estimate a given option pricing model. That could be the Black-Scholes model, like Heston model, or could be like a more ad hoc model, like what practitioners usually use, like the ad hoc Black-Scholes, which is like to basically fit a parametric model to the implied volatility surface, which is implied by Black-Scholes. And after that, you can look at the residuals, and then you can try to fit this residual by a certain neural network. And in the end, you can use the hybrid results, which is going to be whatever the model you condition plus the neural network to either interpolate data in a cross-section or to forecast future values for the implied volatility surface. And the results are interesting. Well, we find that empirically, the models that are corrected, they outperform the original models in like a reasonable amount. Like our measure here is like a root mean square error of the implied volatility surface, and we could get much better results. And like both for interpolation as well as for forecasting for different horizons, like 1 day, 1 week, 21 weeks. What is also interesting here is that like there are two ways of implementing the feed-forward neural networks that we do. Like one is really like we were thinking like suppose you have a practitioner and like you want to predict the implied volatility surface for tomorrow. So what you're gonna use like the most recent data. Like you're gonna use the cross section of options today. So we have like very large cross sections of options, like with S&P here. Like a more recent data is something like 1,400 observations in the same day for different maturities and moneyness. But so then like that's the first exercise we do. We call it a cross-section exercise. So we fit the neural networks to the residuals of the model implemented for just one date, and then we try to forecast. But the other interesting question that we could ask, and that's more interesting from an academic perspective, but also I'll tell you why it could be interesting for practitioners too, which is like maybe I want to fit like an option pricing model for a whole panel of data, where I can also use other variables, like for instance, macroeconomic variables, to see if I want to condition on like market like situations like high volatility, low volatility, or any other variable, and to see if this like if I can improve my forecasting power by conditioning on this variable. So we do a second like exercise where we fit the model, and in this case we choose one model, which is the Heston model, stochastic volatility, through a whole panel of data. And after that, we fit the neural network using some like covariates, some features that are like time series, and actually show that it improves with respect to just like a traditional neural network without this feature. So that's a very simple paper. Those are the results that we obtain. You know, like that the neural networks, they help to boost the models, and that if you fit a neural network to a panel of data, then like maybe using some additional features, macro variables might help in terms of pricing. So what we do, like we use, you know, like an implied volatility surface. So I think most of you, if not all, know what I'm talking about. But basically, we use the Black-Scholes model. invert the volatility that would give the right price of the option in the market. And this is invertible because the price has like a monotonically increasing relationship with the volatility. And then you can always you can kind of represent the prices of options through this like surface. And that's a big advantage because you can put in the same perspective options that have different moneyness, while the prices, they kind of are much higher for at the money options, right? So what is also interesting is that you can look at this object, that's our object of interest here, as a function that's a bidimensional function that takes one moneyness and one time to maturity and maps in the implied volatility. So that would give you like a very natural environment to apply a neural network, which is a universal approximator. So that would be the idea. Like neural networks, you can think about them as like adaptive basis functions, smart basis functions that condition on the data that you have. So we thought that could be like a good opportunity to apply, like a neural net to fit the residuals of option pricing model. Of course, you could use any other machine learning method and could explore much more. So this would be like a lower bound for what you could do, choosing one of these methods. And what we find is actually well, I think I've explained about that, why we use the neural network. So let me kind of so we relate to literatures, different literatures of time. I'm gonna just skip that. And let me just tell you what we do. So if you think about the model, I'm gonna just quickly talk about the Black-Scholes model. So there are many different ways of writing a model. So we're looking from some no arbitrage models where you come up with the stochastic differential equation for the underlying asset, and then you can do that under the physical world and the risk neutral world. Right here, there are many different ways of deriving the Black-Scholes formula. So we are assuming here that we are already looking from the point of view of the risk neutral world. You can solve this by Ito's calculus, and then actually, since you can use some martingale properties of prices. So that's basically option prices discounted. Any asset in this market is going to be a martingale. That gives you this condition expectation to calculate. Well, you have the distribution of your asset. You can just calculate the condition expectation analytically, and you get the Black-Scholes form. So what we're using here, and then Haston model and all the other models, you can think about the same thing. So you have a stochastic differential equation with the state variables. And under the risk neutral world, you're assuming no arbitrage, you are able to come up with the price as some condition expectation. Sometimes you have analytical results, some others you need to use a Fourier inversion or other methods. But the point is the model gives you the state variables and gives you a certain pricing function that you can always invert and map it to the implied volatility surface. So that's what we do here. We use different models. For each model, the model implies option prices. You invert the implied volatilities. Then now we can compare market-based implied volatilities with the model implied volatilities. To calculate the difference, that's going to be the surface that you want to fit with the neural network. So that's what we do here for different models. And then how do we fit our neural network? Well, you get these residuals, as I mentioned, between the market implied volatilities observed for the option prices minus the model volatility. And after that, you just minimize a certain quadratic function in this neural network, where this f is going to be this generic function that is given by the neural network, which is basically obtained by compositions of neurons. So you can approximate any continuous function by any feed-forward neural network and other types too. But in this case here, we're just looking at neural networks. We have many layers. So those are the neural networks that we use in this work. And if you think, you can always think at what is inside this H function as being a neuron, or a set of neurons here, a certain dimension. And basically, it's a linear transformation of your original set of variables, which are going to be your features. And the features that we use here are maturity and moneyness to start. And now you're writing a general, nonlinear function of as a function of these two features to try to map this residuals surface. And you note that Z0 is the initial features. Once you do that, you start feeding this a neural network by just calculating the results of this linear transformation. And then this H function is the activation function. that you can choose like a ReLU or like sigmoid. We use sigmoid here. And then like after that, you're gonna have like a different layers, and that's gonna give you like a deep neural network. In our case, we test like some other results in the literature up to 5 layers, like internal layers, and thinking again that this is like a lower bound for what you can get because we don't fine tune everything. We did like something very simple. Like we didn't select all the hyperparameters. It was like a really simple exercise. And then like what we do, so we followed like these results by co-authors and give different 5 architectures. The first one has just one like internal layer with 32 neurons. The second one, which we call NM2, it's like 2 internal layers with 32 and 16. Like you keep including more layers and like and decrease the number of neurons. And like what we get in terms of empirical results, like quickly now, like we have 1.3 million options, like in general, like on average, like 1,400 options per section. And so this is the classification of the different options. But what's important here is that the average implied volatility is around like 18%, the implied volatility. And if we look at the models, what we do, like the first column here is no neural network, it's just the model as it is. So Black-Scholes, for instance, if you're doing interpolation for the same day, gives you 7% error. So that means if an average implied volatility is 18%, that's like almost half of the price in terms of volatility, as an error. Once you introduce, like the hybrid approach, you go down to 0.21%. So like a really correct the model. So other models like they adopt Black-Scholes, of course, which is the one that fits like a parabolic, like a surface for the moneyness and maturity, has a much smaller error. But again, once you introduce the hybrid approach, in other words, like instead of only the model, you first run the model, then you run one of the neural networks, you again go to very low pricing errors, like a 0.17%, 0.16%. And the champion here is the Heston model that started very well with 0.9 already and went down to 0.15. But the point is like all the models are improved, independent of the level of the original error. So Black-Scholes is the worst because Black-Scholes gives you, by definition, a constant volatility for the whole implied volatility surface. It's just like one number, and after that you have to correct. So basically correcting Black-Scholes is the same as running a pure neural network directly. So that's what we show in the paper. It's a very simple thing to show because the neural network can observe this constant. So if you think about correcting models, you can think that the most a simple correction that you can have is for Black-Scholes, which is to run directly the neural network. But the combination of models with neural network apparently does better than the neural network. And the same for, once you try to do forecasting instead of interpolation, you see that you start improving less sometimes, but even getting this ad hoc Black-Scholes, you go from 1.9% error, which would be like a 10% error in implied volatility. Remember, that's 18% implied volatility, the average one. And you go down to almost close to half of what you had before. So in other words, it works even without a lot of optimization in the results. And the last thing that we do I have 1 minute? Yeah. So we implement, as I was telling you, the Heston model. Now, after you implement the Heston model for a whole panel of data, we use the residuals to train our neural network. Also, all the results I'm showing you, by the way, are out of sample pricing here. So now we train this neural network the best of the 5, which is NM3 with 3 layers. And we showed that actually we train it without the macro features and with the macro features, and you can see that in terms of errors, the errors go down substantially if you include some of these macro variables, which means maybe there is room. That's one of the advantages of using a neural network. There's no curse of dimensionality compared to running a non-parametric regression directly there, and you can include those features without much work. And you can do some analysis of feature importance, kind of shutting down some of the channels. And we show that, of course, maturity and moneyness are super important, but also fixed and LTV, which is a measure of left tail risk. In other words, which would be variables that are related to state variables that would appear in the original option pricing models more general than Black-Scholes, for instance, Heston or a jump diffusion. So that's what we get here. And I know that Ruy is coming now. So neural net can help us, and just like to make one tiny connection with what Svetlana was saying, that this was the most basic thing we could do. Of course, we can twist your loss function to include like some economic restrictions here, and the most basic economic restriction here would be to impose no arbitrage to the implied volatility surface. You can just put some like additional restrictions like you do with loss or ridge in terms of the realization in the loss function. So that's easy to do.
Caio, and last but not least, Marcelo Medeiros. Stop sharing the screen. Everybody wants to see you.
Yeah, so thank you everyone to be here. Good afternoon. My childhood dream was to give a TED talk. So to give a TED talk, you need to put this on your head. Do not talk for more than 15 minutes and do not bring slides. So that's what I did. It's not really good here. That's okay. I got like a 2 out of 3. Okay, so you are here because you want to learn a little bit about what machine learning can do for finance. So I'm going to talk a little bit on my view and my experience on that, on my view on what people are saying that's machine learning. Machine learning is now super popular. You see machine learning on the news, non-technical people are talking about it. So it's kind of buzzword, right? So, but machine learning is out there for many, many years. In my case, I have been working of what we understood by machine learning for 30 years. The first time I saw the word neural networks was back in 1993 when I was an undergrad student at the engineering department at Rio, right? And then I started to work with that. And nobody cared at that time about neural networks. Okay? I was the weird guy, years later in an economics department doing neural networks, where nobody cared. And all the economists that were publishing papers on neural networks were usually publishing in journals not related to economics. Okay, the late Hall White had many papers, very interesting papers, seminal papers, and they were all published in neural network journals. Okay? And why is that? Well, because at that time, data were not that big, right? The data sets were pretty small. And when you compare, so in my case, I was working with like economic time series forecasting. When you compare like with like the linear models, right? Oh, the linear models were sometimes better or sometimes as good as, and you don't need to put a lot of effort on estimating those models, right? So nobody really cared. But then there was the data revolution. So now we have big data. Svetlana talked about the factor zoo. So Caio talked about the millions of options here. So we have huge data sets. And some of these data sets are impossible to analyze with regular tools and linear tools. There are a lot of nonlinearity out there. Okay? And also computational power. Computational power became cheap. You can buy time at AWS for couple $100, so it's not very expensive. Even if you want to buy a workstation and put in your office, it's not that expensive. So it became very cheap, like to estimate these models. Okay, but what are these models? Well, I can assure you that more than 90% of the machine learning methods that are out there, they are statistically based. They're basically non-parametric statistical models tuned to deal with large data sets. Okay? Lasso and its friends, regularization, which existed since the beginning of the 20th century. Okay? So it's kind of old ideas that now are computationally feasible to run, and there's a lot of theoretical results out there. But there are mainly statistics, or even if you look at reinforcement learning, well, this is dynamic programming. Anyone who took a course in dynamic macroeconomics will see several similarities between reinforcement learning and dynamic macro, right? So these are kind of old ideas, but that became very, very powerful because you can apply them to this huge data set and try to find patterns on these data sets. As Svetlana very well during her talk here, you have this zoo of factors, and you need a way to figure out which factors matter and how to combine them, right? And putting like economic intuition, economic restrictions on the market is super important. Okay? So all that said, how can the finance industry can benefit from like the revolution in data and the data zoo, the model zoo, because now we have a zoo of different models, of different techniques that can be used. So I can tell you some of my own experience with work that I have been doing as a researcher and also as independent consulting firms. For instance, like forecasting large set of economies, right? You have to forecast like inflation, output growth of a large set of economies because you invest in different countries, in fixed income instruments. And so you need to know how interest rates will move, how inflation will move. So you have to construct this forecast models. And nowadays you have large data sets for every single country. So you have large number of countries, a large data set. So machine learning can be super useful, like in forecasting inflation, right? For instance, like techniques like random forest or neural networks are very effective, right? And learning patterns from these huge data sets. Okay? But also, we can combine these methods with non-trivial data or unstructured data. It's not the data that you can download from Bloomberg, okay? But this data everybody has. So you want something that can be unique. So look, for instance, at processing news data, so text-based data, like now it's not Twitter anymore, it's called X, but whatever that social media, there was a lot of information there. We wrote a paper that we're going to be presented in the conference in Santander this weekend on using Twitter posts to predict inflation. You have online prices. So there's lots of data that's not unstructured that you cannot get from Bloomberg, for instance, that you can combine with different models and use to predict inflation. So this is one area where the finance industry can benefit, like large data sets combined with very cutting edge forecasting models. Of course, there are also the factor methodology. If you have factor investing, all the methods that Svetlana mentioned, okay? But also if you kind of invest in sort of mean variance portfolios and you have a large set of assets, you have to construct your covariance matrix, right? And this covariance matrix nowadays can be very large, like more than 1,000 instruments sometimes that you may have, right? So machine learning can be very effective on how to estimate these covariance matrices or precision matrices that you can use to construct your portfolio, right? And I also have a recent paper in the Journal of Econometrics where we use a new technique construct precision matrix that will be used to optimize portfolios based on chart ratio. Right? So this is another possibility that we can use. And also now there's a recent paper by Dashan Xu and co-authors. It's going to be also going to be in the conference in Bahia, where they use images to predict stock market movements. And they are using cutting-edge convolution neural networks. That's something that has been constructed to recognize patterns in images, like recognize if it's a cat or a dog, but they are putting graphs of past price movement, and they are feeding the network with these images, thousands of images, and try to figure out what's going to be the future movement. And they show that the method can be super successful.
Technical analysis.
It's a technical analysis in the 21st century, in the machine learning era, right? So there are many things that can be done, right? And what I want to tell you that there's no magic. So machine learning is like statistical methods, like coming to this new era of large data sets, different data sets, not the tabular data that you may have used to, like downloading data from Bloomberg, but data that are coming in super high frequency and in different formats. So these techniques can be very useful. So if you ask, can the financial industry benefit from these advances? My answer is yes. There are a lot of things that has to be done. And this kind of partnership between the industry and the university, the academia, is super important to be like on the state of art of these methods. Okay. So I think I have 15 minutes. Yeah, great. So 2 out of 3 in my TED talk today. So thank you very much.
Very much. So I'd like to welcome Fernando, Svetlana, and Caio to join for Jack. Thank you very much, Marcelo. So I guess the idea here is to have a discussion. And maybe I'll start asking a few questions. But point of this, I don't know if you want to sit. Sit. You want to? Yeah. Fine. So. I used to have a Q&A as well, so can ask questions as well. So since Fernando has just joined us, I guess maybe you can tell us a little bit about the experience that you've seen in the use of machine learning and the AI. I guess we haven't talked so much about AI, which in some sense is a subset of machine learning. I guess I'll call it that way. We didn't talk about large language models, for example. Maybe talk about that later as well. If anyone has any idea of that. But maybe Fernando, I don't know if you want to give your views on applications. And
I think it's interesting to say I learned this lesson that was done of asset managers that apply AI, generative AI, in my topic. And some of them said, I think they have some consensus. There are a lot of to do. The first one is that using social media information is really difficult. That's why at first it's not trustable. And there are a lot of different stuff like emojis that are not easy to understand what they mean. Sometimes they can mean something, and other times they can mean another thing. So social media data is something that they need to learn how to do. And another thing that is a kind of consensus is that the use for generate hypothesis of generative AI is doing quite well, but not to validate this hypothesis. So you can have a lot of information from newspapers, from media, everything, and this will help you to generate some idea and even investment idea, but to test and to validate and to make sure this makes sense. Only the LLM models are not working. And some of them also said that they are really concerned about the security things that are related to this model, because of course, use your own data and you run this public LLM models, so it will train the model and it will be available for everyone. So some of them are like developed what they call small language models. That is a kind of proprietary and much smaller trained model. That's the cost is much lower, but combined with these LLM models, it's performing well for specific tasks. So, and the other one, of course, is used for textual analysis. I think this is something a lot of people are doing. We are doing this as Bradesco Asset. For example, we use this kind of technology to analyze and we created a metric for central bank minutes and statements. And we tested this metric and it's kind of working. So I think this is an overall view of how these generative AI models are being used. And a lot of them are being used for productivity. So helping to code and helping to analyze hundreds of or thousands of documents. This is also a process.
Would you like to share some of any views you may have on the topic of LLM?
I absolutely agree with this about use of this kind of language models. I have been working on a couple of projects already to read already and options of all things. And obviously what's the best, the lawyers forum are already they've been on, so we have all the data, so it's perfect. It's very difficult for us because they do post pictures. So if you want to have like sort of a complete language model, you need to be able to recognize not just emoji, but also memes. And so and everyone familiar with language models in text will also know that sarcasm is very difficult to detect. So there are a couple of kind of databases, in particular there is a Twitter data set where you put a hashtag sarcasm so that you can sort of train your language model on the listing of those things. But generally, it is very difficult, especially for certain communities, to analyze this type of data. So, for example, minutes of the central bank meetings, of course, we're not going to have emojis. It's much easier to process. Or, for example, conference calls, like earnings announcements, things like that. So there are also a lot of important data there. But it's good that social media is very, very difficult.
I don't know much about the large language models, but what I can say is that I attended a big meeting a couple of weeks ago with Princeton. There's a lab there. Sanjeev Arora is like a super impressive guy in there of complexity of algorithm. He switched to large language models some years ago, and he's fascinated. And they are like they received like a $10 million to work with that, which is like a very big amount of money for academic work. And during this meeting, they were describing the evolution of the GPTs and things related. But one of the main concerns is really like about hallucination of this model. So now we were looking at the results, and then they can start creating things that don't exist. Like, for instance, if you ask like for a technical report, they can like give you references that they just invent. And so how do we deal with that? If you want to expand to like a more extreme cases, like suppose you put like a machine based on like a large language model to drive a car, and we need like to make decisions like so if there is something about to happen, then like if I deviate, I can avoid like killing 10 people versus saving the person that is inside. So how do you manage that process? It's a super hard problem to solve, even as a human being. You just gonna have to make a decision at that moment. We don't know, but like they are concerned about these kind of things, and of course, like a human is fundamental. That's a big thing everyone is sleeping, and then also that's a big thing there because there's a lot of money involved, and it was a 3-hour meeting. There were like many different multidisciplinary people talking about how they are applying LLMs in their research, and like we are started also like a real new paper with a couple of co-authors where we are working with the identification of the SCF condition, SCF based on like a news, and then we want to process this news, and then that's like a problem what exactly is news and how to map your information set at a certain point in time. And one of our ideas is to use topic policy to kind of classify like scenarios in different topics, and that would be one way of kind of defining state variables that can be used for whatever the crazy math like math is going to do to deal with the conditional, like the real true conditional information, and not like an instrument things. But that's the idea. So we see how it goes. There are different ways of creating the state variables. It's really a rich topic.
I think, given the time, maybe we should open for a Q&A. Anyone has any questions for any of the speakers?
Usually searches about so maybe rule of thumb and regularization techniques that you must do before picking the data. How can you measure the foreign apple from neural networks? Has layers defined and how much of this is more sense eventually like this 200 layers. Okay. That's why I don't that I am. So how will you tackle this influences between backtesting and overfitting?
Questions about overfitting and how to handle that risk. Anyone wants to address that question?
So there are two types of errors, or you can put this in type 1 and type 2, right? So the risk that we are trying to find a trade-off here is missing something which is really in the data versus creating some fake, empirical evidence with what's the data. I'm much more cautious on one type of this error. So that's why my approach to any kind of data exercise or procedure is also quite conservative, because I'm going to run regressions once. So I'm going to spend a lot of time, for example, thinking about the method, just design its architecture, start unique property or simulations, something like that, to make sure that I understand what are the settings where it works and where it doesn't. So, for example, before I would, I don't know, if I were to do like a return predictability regression or price simulation or something on the market data, I would first do a lot of simulations with a random forest, figure out all different signal to noise ratio, what exactly is going to be picking up and not, where is all the happening and not, so that I know the properties. And only then I'm going to be running the points. So, for example, the Bayesian paper that I presented, like honest to God, they did empirical analysis once. They never changed anything, none of the tuning parameters, nothing, whatever was in the data, that's it. But again, my approach to this is much more conservative. So I would absolutely imagine that there are plenty of things that we could have found in the data, or in some other projects, and they have to be killed because that one pass that after careful thinking approach didn't work. Maybe a second or a third one would have worked, but that's just my honest thoughts.
Caio, maybe you have a lot of different levels of layers, and so I got the questions for you.
So I come from an engineering side, and I kind of I migrated to a more hybrid. But I was working with engineers in this project, for instance, and we really took this not the approach, but we looked at different models, and even for the models, we started doing something much more complex, and then we realized let's do something basic and look at what people recently have done, and then there are these other outlets that are kind of also working a lot in Sheng and cooperative. They proposed those 5 neural nets, so we went with them, and but there's not a lot, I have to confess, of analysis of why one versus the other. But going back to your questions, what can we do in regularization there? I think that there is a recent paper by Brian Kell and co-authors talking about the virtue of complexity, and in this paper, I have to read it more carefully. But apparently they are arguing that if we increase the size of models this machine learning models where like I would classify neural networks as one of them, that actually like it is good for the model that there is no overfit. What I can tell you is that because you can ask why, right? Like if you're gonna, so all the things that we were using there were out of sample, and that's one of the things that helped. Like so you have like this like a model that you bring from the literature before training and testing, and then you test out of sample. And then you can do cross-validation, can do something else, and like so cross-validation, there are complications. So there are some theoretical papers now trying to show where in which environments cross-validation really works. I mean, each one is just like choosing something to report. Right? So all of these things are related to what you're saying. But there, like I would say that like this idea of using out of sample data and looking at the different neural networks, they were all very simple neural networks. I think that we can like visualize that being conservative as a lower bound of what we can do with machine learning. Can I look at like a 200 layers, or like with a much larger number of like neurons? Maybe that could be like another project where the objective wouldn't be like really boosting option pricing model, but would be much more like a learning more about the limits and limitations of like increasing the size of this structure. Because I like going back to Cal's paper, I don't know all the details, so they might again have some assumptions there, as anyone has. So I have like a quick question for Svetlana about the assumption that you guys did in your work. Like it's like when you do spike and slap and combine it with like the Bayesian. So how does this relate, for instance, to the things that like Nagel and co-authors did? Because there they show something different. They show that like those like principal components like models would work well, but with a very specific metric for a square out of sample pricing, which look high to me. They don't look at the pricing.
So yes.
But it's also a choice.
Well, it is absolutely a choice, and one of the reasons that approach, the 2018 Finance did a free paper, and that's the reason it works better. It works for the individuals because they take all, let's say, for some principal components and then apply reach on top of them. So ultimately, it's sort of like averaging, everything that you have. So going back to Frank Hayes' paper, version of complexity. I mean, indeed, it shows that with an increasing complexity, with simple performance is going to be better. But you should not forget that he's also using the penalty on top. So that's why, even though kind of the nominal complexity increases, the actual complexity is still being kept intact by the shrinkage, which is embedded in other procedures. And actually, if you look at the original statistical paper, which was the motivation for this work, that's exactly how they explain it. Complexity is great because we can actually manage it with shrinkage, with all these different. So it's true that different choice of the tuning parameters and all those procedures. To be honest, I don't think that there is a universal approach that really provides the best practice. You want to be safe in your analysis, and again, different people are facing all sorts of different trade-offs of type 1, type 2 error. But I think a safe practice is to change one thing at a time. Because if you let's say know what's the baseline performance of like 5-layer neural network, and then you're going to modify it, then you know exactly where the difference in the performance is coming from. It's when you have like a lot of moving blocks, that's where people start to get suspicious because they're not sure what exactly generating what. Like sample split, cross-validation, number of layers, things like that. So doing sort of one step at a time and showing exactly what it means to the table, that seems to be just a really reliable path.
Quick follow-up comment, which is so in that case we have a very small number of neurons, but if you wanted to go with your choice, one possible way of regularizing not only shrinking could be really like because we're using very gradient descent there, but you can one of the ways people show that it works very well for neural nets is to really randomly select to kill some of the connections and you average in the end. So that works for large networks, kind of like doing a random a selection and an average of all the nodes.
Could you change a little bit the topic, but I think that's interesting for the audience here, because we have a lot of friends guys here, and emerging markets data are not as, especially historic data, not as much as. So I know that you have worked on this, Svetlana. Can you share with us how to deal with missing data and how this, like a fast view, what's the desirable approach to deal with that, and how machine learning or AI can help on that?
Absolutely. So this is really one of the topics that I'm quite passionate about. As anyone who would work with data, even the most ideal ones, so let's say US coverage of foreign characteristics, you'll find out that there is a lot of missing observations. And quite often it's not missing advantage. So for example, the example that I always have in mind is that of R&D expenditure. So if you look at the firms who will not report anything on R&D, because it's not required by listed companies, you will find out that about half of all the firms just never disclose it even for a period of more than 20 years. That said, that doesn't mean that they don't do any of the R&D. So for example, one of those companies who reported who did not really disclose any R&D data for more than 20 years is Coca-Cola. And during the same time, they filed more than 1,000 patents. So point is, the data that we have in economics and finance is quite often have very clear coverage. And also it has this clear coverage for a reason. So not just whether something is observable or missing, but also whenever it's observable, quite often it's also going to be debatable whether it is true or not. So particularly in the context of ESG, if you think about, let's say, emissions, all of that data is actually not computed. So you most of the time estimate it by different, rating agencies, and whatever is the model that they use to impute that missing data, and as a result, allocate form to the green or the brown, groups. It's a big question because the correlation between, ESG indices for the same group of firms are almost close to zero. So there is a massive disagreement across what different companies are doing. There are indeed many methods that have been suggested dealing with missing data, starting from the 60s, like Kalman filter-based imputation and things like expectation maximization. Recently, missing data has actually been also the focus of text-based models. Because if you think about sort of completing a sentence or coming up with a certain structure, it's a little bit like imputing words, into the phrases. So there is a lot of algorithms that have been developed there as well. The work that I've been dealing with missing data is focusing on firm characteristics, and we wanted to have something that's going to have a very clear structure, so that we could understand exactly what are the assumptions behind it. What are going to be the assumptions on that missingness, and as a result, the type of patterns we're going to be able to recover from the observable data, and what type of patterns we would not be able to recover from the observable data. And this is exactly what currently sets us apart from most of the machine learning methods, because they sort of work in some simulations, but we don't really know why or when they're going to fail. So the method that we deal with is a combination of latent factors and autoregressive models. I don't want to speak too much about it, in part because we're very actively revising the paper. So next month, probably there's going to be a new version, and the new updated version actually works much better than the previous one. So we're very happy because we got great comments from the referees. So for the next month we'll get it, and I'll be happy to talk more about it. But it's a difficult problem because the data that we have is both in cross-section and in time series. So I think about something which is persistent, let's say, some feature of the business like investment level or something like that, or emissions for the same example.
You look to credit market too?
No, we didn't look at bonds. Yeah. And at the same time, we also know a lot about the company. So for example, we can have some other data, whether it's bring back some other characteristics, and you sort of try to learn both from the time series dimension and cross-sectional one. So this becomes in statistics kind of a tensor, sort of approach. And models that we currently have to deal with senders, which again becoming more and more tractable with machine learning, but they're still just an emerging field. So it's a very, very difficult thing, and we need to sort of separate somehow these dimensions so they can make impact. So if anybody's working on tensor-based model for prediction analysis, things like that, great choice. Great area of research, and send me the papers. I would be really, really happy to see, what you guys are working on. It's really one of the kind of cutting edge areas of the statistics, and we're just beginning to learn like what can be done there. I think there's, all the big data that we have in all the applications, there's going to be more and more confidence.
More questions? Everybody shy? Yeah. Okay, speak.
Thank you for your participation. I'd like to know a little bit more your views on risk management and its challenges, especially a lot of risk management or the difficulties in validating and checking. And also complete evidence.
So I talked to some of the people from the industry, and I think one area where they agree is that the perspective for machine learning in the risk management areas right now are much more clear and much more better understood compared to, let's say, designing strategies that should deliver some answers. And one of the very simple rules that you could get for, let's say, strategy design and testing that goes around, overfitting a little bit, is to have two separate teams that do not talk to each other. So let's say, ideally do not talk to each other, but like one team who is responsible for designing strategies, and the other independent team who is responsible for testing those strategies. So that they do not know what exactly is going to be the sample split, they do not know what exactly are going to be like robustness to tuning parameters and some other choices, so that there is not going to be kind of reverse engineering, what works well in out of sample, but actually was in sample because, like in most of our papers, we take 3 quantitative data and divided it like 2-3 parts, and we call it out of sample, but we can't see the data, right? So kind of pure, really out of sample validation on the data set, and without knowing what type of tests your algorithm is going to be subject to. I think that's one relatively simple and feasible rule that can be implemented in a lot of funds organizations, and I know that some of them are already doing that. And risk management, so this is where it's going to be absolutely useful. So again, monitoring, analyzing big data, let's say KYC. So a lot of the all these companies, banks, they have to support database of, what's happening to their client and creditors to make sure that there are no like red flags. So analyzing suspicious transactions. So those algorithms that are going to be, flagging, and you have to report to regulators. Those algorithms rely on machine learning as well, quite often these days. So more and more things with regards to cybersecurity and operational risks and market risks as well. And so, for example, for the model of pricing of options, all of those things are being more and more implemented. And it's the operational risk, which is quite often really going to be a big issue for many organizations, but it's difficult to quantify. Again, machine learning just provides you with a lot of really nice tools to analyze a growing plethora of data. And that's why I think currently, again, the consensus is that risk management is where the benefits of machine learning are much more clear as of now. But again, things are changing. Computational, costs are going down, and it's getting easier to analyze more and more data. And so it's getting also much more easier to design new algorithms that have different properties. So maybe things are going to be changing as we speak. That's all.
I'm not sure if you were thinking about like risk management from one operational perspective, like how to come up with like this measures for next day or something like that. But also
more about model risk. Yeah,
model,
yeah.
But in this
Model
case, we definitely have model risk too, right? Like so, and if you're trying to come up with like a measure of risk for, let's say, tomorrow or like next week, and so I teach risk management course in general. Like I start talking about stylized effects of return, and like we know that volatility is time guarantees, stock markets. And but I'm a former risk manager too, like from I used to use like a VADAT risk there and a historical simulation. And now we know that this is still like implemented in most of the places, but with many limitations. And I think like one of the things that like is limited is like how do you deal with this like a very large cross section of assets if you really want to consider that like volatility is time varying, which is a fundamental feature, right? Like a cycle simulation wouldn't. Then you need to evolve to something like a future cycle simulation. And how do we model these patterns of like the joint covariance matrix? So you go back to machine learning methods, factor modeling, but definitely machine learning can help you there. And also like in predicting the expected return, because in general, like we start like when I started this course, the expected return, it's like a return in stock market is not predictable. Yes, by simple autoregressive, right? But you start like putting together like the whole cross section, high frequency data, macro variables, then you get a much better predictability there. So that means if you really want to go for a more detailed analysis, so maybe you wouldn't just disregard that. So it depends really on our depth. When depth is more like a big picture calculation of this, then you can still like say, okay, I'm gonna just like concentrate on primary volatility. Like so, I think that machine learning definitely can help you to pin down this expected return. The covariance matrix can allow you to cross section if you think about the future cycle simulation. And if you go back to the analysis of like a credit data, and so definitely people used to use like a probit and logit. You can both support vector machine like other models that are gonna use like kernel tricks to look at like a much higher dimensional space, but to try to separate data in a non-linear fashion. That's my opinion.
Another would like to add something? I think that one thing that Svetlana mentioned that is QIC. I think that it's a different dimension of risk, of course, but I think the generative AI models will be really effective for this kind. So it's much easier to have different profiles of risk for investors and to do better than we do today. So there is a big role in that.
Okay. Yes, given the time, to finish, yes. So I'd like to thank you very much for being here with us today. Great for all the presentations and the chat. Of course, everybody who's here can also ask questions to the panel after we finish. Thank you very much.